Hi everyone, it's Danielle Jackson. Thank you so much for joining me for another 3 minutes of real estate. In this episode, I'm going to continue breaking down the fundamentals surrounding what's happening in the multifamily market. And I know so many of these topics are making headlines, especially with the current capital markets disruption. And so right now we're seeing headlines for multifamily that are highlighting perhaps stagnant rent growth or normalization of rent growth based on historical averages, and in some markets, even some negative year-over-year rent growth. So with that, we are going to actually jump into the most recent Yardi Matrix report that covers year-over-year rent growth. So the first thing to highlight is this report articulates that the average US multifamily rent actually remained flat. And this is on a national level across 140 markets. And it's also all multifamily asset types. So class A, B, and C. And that average was $1,702 at the end of February. It also highlights that this stagnation is coming after the seasonal, what we call the cyclical or seasonal winter slowdown. And they are suggesting that multifamily investors focus on three very key components that will have a large impact on future rent growth. And those three items that they're recommending we keep a close eye on are household growth or new family formation, new inventory in the markets that you're investing, and if multifamily rents actually follow their typical spring pattern, which we're just starting to get into those spring months, when rents in multifamily actually typically they increase over this period of time. So we certainly all will be keeping a very close eye on the behavior and the patterns surrounding those three key indicators. Another note, I think it's important, especially since Ashcroft Capital invests in affordable housing in multifamily apartment complexes. This next point is critical. They are saying that rents in the upscale lifestyle segment declined 0.2%, and in the renter by necessity component, they were actually up 0.2%. And that indicates that affordability is playing a very big role in demand. Last but not least, it is so cliche, but location, location, location when it comes to real estate. And this chart that I want you to take a look at is a key indicator of that. So this particular chart is breaking down 30 major metros, and you'll see that that blue line that's going across the middle is 2.8%, or the 10-year average for year-over-year rent growth. Now, there are a handful, actually two that had negative rent growth, and just a couple that were just right under that national average. But as you look farther to the left, and you'll notice some markets that Ashcroft actually invests in, including Miami and Orlando, which are both up north of 6%. You've got Raleigh-Durham, which is hovering right about 5.5%. You've got Dallas that is right neck and neck with Raleigh, right about 5.5. And then we've got Tampa as well, which is also ahead of the national average. And the only one that's falling just slightly short of national average, and there has been some softening in rent growth, is the Atlanta market, but that's still hovering right about 2.3%. So I know those headlines sometimes can feel scary, which is why diving into the data just a step deeper is always really helpful, and getting a bit more specific into the markets in which we invest. So I hope you found today's episode informative and helpful. As always, please do reach out if there's any questions that you'd like to ask, or I'd love to continue the conversation. So thank you again for tuning in, and I hope you join me next time. Bye-bye.